Today, Nokia is no longer a consumer brand. Instead, it sells the technology that powers the world.
On July 18, 2012, Nokia's stock didn't just fall. It collapsed to €1.33, a price so low that when viewed through the lens of inflation-adjusted valuation and historical market capitalization trends, it represented a destruction of almost 98% of shareholder wealth, a collapse so severe that it no longer resembled a normal market correction, but instead appeared as a complete structural breakdown of long-term investor confidence in a once dominant global technology empire. At its peak, Nokia had been worth more than €300 billion in market capitalization, a valuation that placed it among the most powerful corporations in the world. But by 2012, that number had been reduced to almost nothing, leaving behind not just financial damage but a psychological shock across global markets that had once viewed Nokia as untouchable. But the real shock was not the stock price itself. It was what it represented beneath the surface, because a company that once controlled nearly 40% of the global mobile phone market, that shipped over 450 million devices per year, and that contributed roughly 4% of Finland's entire GDP, was now being described by analysts not as a struggling competitor, but as a structural failure in real time. A phrase that implied something far deeper than temporary decline, suggesting instead that the very foundation of Nokia's business model was breaking apart under the weight of technological change. And here is where the contradiction begins, because even as bankruptcy discussions increased internally, Nokia was still generating billions in revenue from legacy devices and network contracts, still operating at a scale that would normally sustain a major global corporation, and still maintaining infrastructure partnerships across continents, which makes the situation far more complex than a simple collapse story, because the question was no longer whether Nokia was dead, but something far more dangerous and far more confusing. Why was a company with billions in revenue collapsing anyway? And just when the industry had finished writing Nokia's obituary, just when analysts had finalized their conclusions about its downfall, a new signal appeared in the global technology landscape, one that did not fit the narrative of failure at all, because in 2025, NVIDIA announced a $1 billion strategic alignment with Nokia, tied not to smartphones or consumer devices, but to AI infrastructure and next-generation telecom systems, representing a shift in relevance that nobody in 2012 could have predicted. And suddenly the story was no longer about collapse, but about something far more unusual in corporate history: transformation under complete pressure. At its peak between 2004 and 2007, Nokia wasn't just leading the mobile industry, it was dominating it at a scale that modern technology companies rarely achieve, operating almost as a global standard rather than a competitor in a fragmented market. Annual revenue crossed €51 billion in 2007. Operating margins exceeded 20%, and global shipments reached more than 470 million devices annually, meaning that nearly 500 million people every year were interacting with Nokia hardware as the primary interface of mobile communication. In many emerging markets, Nokia held over 70% market share, effectively becoming the default communication device for entire populations, which meant that for millions of users, Nokia was not a brand they chose, but a technology they inherited as part of entering the digital world for the first time. But the deeper strength was structural, and this is what made Nokia different from competitors at the time, because Nokia controlled carrier relationships in over 150 countries, manufacturing hubs across Europe and Asia, distribution channels that competitors could not replicate, and supply chains optimized for mass production at low cost, creating what analysts later called a closed ecosystem of physical dominance, a system in which scale itself became a barrier to entry for others. But inside the company, warning signs were building quietly, almost invisibly, because internal reports from the early 2000s already showed software development cycles that were 2 to 3x slower than competitors, fragmented operating system architecture in the form of multiple Symbian variants, and rising internal resistance to platform-based thinking, which at the time were considered manageable issues because hardware was still the center of value in the mobile industry. But the industry was preparing for a shift that would destroy that assumption completely, and Nokia was standing at the center of that transition without fully realizing what was coming. In January 2007, Steve Jobs introduced the iPhone, a moment that would later be recognized as one of the most important turning points in modern technology history. But internally at Nokia, the reaction was not panic, it was dismissal, because early teardown reports highlighted issues such as no physical keyboard, high manufacturing cost, and a fragile design compared to Nokia devices. and at the time, the data seemed to justify that skepticism. By late 2007, Nokia still held approximately 50% global smartphone market share, while Apple held under 3%, which reinforced the belief that Nokia's dominance was intact and that the iPhone represented a niche premium product rather than a systemic threat to the industry structure. But beneath the surface, something critical was changing because Android entered the market in 2008, creating an open ecosystem that would fundamentally reshape the industry. And this is where the first real conflict began, because Nokia was still optimizing for hardware superiority, while Apple and Google were optimizing for ecosystem control. By 2009, app ecosystems became the primary value driver. Developer migration to iOS accelerated by over 300% year-over-year, and Nokia's Symbian platform began losing developer participation at a structural level, meaning that the foundation of future software value creation was shifting away from Nokia without immediate visible collapse. Then came the breaking point, the Nokia N97, marketed as an iPhone killer, but instead becoming a case study in failure, with touchscreen lag issues reported globally, an app ecosystem with fewer than 10,000 applications while Apple exceeded 500. 0 by 2011, and return rates increasing in multiple regions due to performance instability, leading one internal executive to describe it as a product built for a world that no longer exists. In 2010, Nokia appointed Stephen Elop as CEO, and just 5 months later he sent the now famous burning platform Memo, which described Nokia's situation in brutally clear terms. Symbian was collapsing, Android was accelerating rapidly, and Apple had already redefined the smartphone economy, framing the entire industry shift as a crisis of survival rather than competition. The metaphor was intentional: stay and burn or jump. The decision was made. Nokia abandoned Symbian and partnered with Microsoft, building the Windows Phone strategy on a core assumption that if Android became overcrowded, Nokia could differentiate through exclusivity within a controlled ecosystem. But the market reaction was immediate and unforgiving, because between 2011 and 2013, Nokia's smartphone market share dropped from 33% to under 5%. Developer support collapsed due to low platform adoption, and Lumia sales peaked at approximately 36 million units over multiple years, compared to Apple selling 150 million iPhones in 2013 alone, highlighting a widening gap that could no longer be closed through incremental improvement. And the most damaging factor was time, because ecosystems do not wait, and once developers commit, switching costs become irreversible, which is why Microsoft itself later wrote off more than $7 billion from its mobile strategy failure, leaving Nokia in a position where it was no longer competing, but simply surviving. In September 2013, Microsoft acquired Nokia's Devices and Services division for $7.2 billion, and at first glance it looked like an exit at the bottom of the market. A forced liquidation of a declining business, especially when compared to other tech valuations at the time, such as Facebook paying $19 billion for WhatsApp, Apple exceeding $400 billion in valuation, and Samsung generating record smartphone profits globally. But Nokia's exit price reflected not just decline, but a complete structural repositioning of the company's identity in the global technology ecosystem. However, what most observers missed was that Nokia did not sell everything, because it retained its network infrastructure business, a division that had significantly lower consumer visibility but maintained stable long-term contracts across global telecom operators. And while the smartphone world collapsed, the network world was expanding rapidly. Global mobile data traffic increased more than 20x between 2010 and 2020, and Nokia remained embedded within that infrastructure evolution, quietly positioned inside a layer of the industry that was becoming increasingly valuable but less visible to public attention. By 2015, the data painted a clear structural failure. Revenue declined from €51 billion to approximately 12 to 15 billion euro. Smartphone market share fell below 3% globally, and over 80% of industry profits were captured by Apple and Samsung, demonstrating a complete redistribution of value within the mobile ecosystem. But the deeper shift was economic, not just financial, because the industry had transitioned into a platform economy defined by Apple's integration of hardware, software, and services, Google's control of an open ecosystem supported by advertising and distribution, and Amazon's dominance in infrastructure and cloud computing. Nokia, despite its engineering talent, global telecom expertise, and manufacturing legacy systems, lacked one critical element: network effects. And without network effects, growth becomes linear while competitors grow exponentially, creating a structural gap that cannot be closed through operational efficiency alone. Nokia's failure was not a failure of innovation, but a failure of timing and structure, because the company optimized for hardware efficiency, manufacturing scale, and physical durability. While the industry shifted towards software ecosystems, developer networks, and platform lock-in, Apple understood early that the product was not the phone, it was the ecosystem, and Google understood that scale mattered more than exclusivity, while Nokia remained positioned in the middle with strong engineering but weak ecosystem development. And once ecosystems formed, switching costs became nearly impossible to overcome, meaning even superior hardware could not compete against locked-in digital environments. Because in platform economies, the winner is not the best product, but the most connected system. After its collapse in consumer markets, Nokia did something most companies fail to do. It stopped trying to recover its past and instead rebuilt its future in infrastructure. Becoming by the 2020s a key 5G infrastructure provider, whose systems powered telecom networks across continents and re-entered global relevance through back-end connectivity. Then came the AI revolution, with data centers expanding globally, edge computing becoming essential, and real-time AI processing requiring ultra-low latency networks. And this is where NVIDIA entered the story. At NVIDIA's 2025 GTC event, a $1 billion strategic alignment with Nokia was announced, focused on AI-native telecom infrastructure, where the goal was not phones, but AI-powered networks that process data at the edge. The market reaction was immediate. Nokia stock surged over 20% in a single trading session, and analysts projected a $200 billion+ AI telecom infrastructure market by 2030. But the deeper implication was more important than valuation. Because Nokia was no longer trying to dominate consumers, it was positioning itself inside the infrastructure layer of artificial intelligence. And that changes everything, because in the next technological era, the most valuable companies may not be the ones you see, but the ones that make everything else possible.